Hello, everyone. Happy New Year. Welcome to 2022. This is the first episode of 2022 for Adam Live, which goes live every Wednesday, 12 p.m. Eastern Standard Time. So thanks for joining me today. Don't worry if you missed it or you're starting a bit late. This will be on YouTube, available for your viewing pleasures at any point. So do not worry. Hope you had a great New Year's Eve, New Year's Day, got to spend some time with your family. And I'm going to jump right in and talk about the 2022 IRA and 401k contribution rules. Now, I know this is kind of a dry topic, but it's the fundamental blocks for being a successful and knowledgeable retirement investor. You got to know the rules, and the rules change. Now, we'll see in IRA world, they didn't change as much, but they changed a lot in the 401k world. So I want to spend some time today going through the 2022 IRA and 401k contribution rules, how they've changed, talk about some strategies, some opportunity planning-wise, and then I'm here to answer any questions you have. So without further ado, let's start right now. Let's start with the IRA and the Roth IRA, because that did not change from 2021. So for the traditional IRA and Roth IRA, it's $6,000 if you're under 50, $7,000 if you're over 50, and that is the same as 2021. Now, it's all about your income. So if you only have Social Security, you only have capital gains, disability, you're retired, and you have no earned income, which is compensation for the performance of services, whether it's 1099, Schedule C, W-2, you need that in order to make IRA contributions. So you need at least $6,000 or $7,000 if you want to maximize your IRA each year. So let's start with the pre-tax IRA. That's a tax-deductible contribution. Once you're over 59.5, you can pull the funds out and just pay tax, no 10% early distribution penalty. However, when you're over the age of 72, you need to take what's called required minimum distributions, which equals approximately 3% of your IRA account. Now, there's some hope that Secure Act 2.0 will pass later this year and will push the RMD age to 75. But as of today, it's still 72. So not everyone could make pre-tax IRA contributions, believe it or not, right? Hard to believe. But the IRS doesn't want to give everyone the ability to get additional deductions. So this is the way the rule works. If you're single, okay, and no one's covered by a plan, so if you're single or you're a qualified widower and you're not covered by a plan at work, no coverage at a 401k plan at work, even if you don't participate, but the business you work at doesn't have a 401k, then you can make pre-tax IRA contributions, no matter if your income is $100 million. Okay, you're still limited to making $6,000 or $7,000 contribution max, but you can do it, and you can get the deduction because you don't have access to a 401k at work. Now, if you're married, filed jointly, okay, and you are covered by a plan at work, then if you make more than $129,000, you can't do a pre-tax IRA contribution. You could technically do a Roth, which we'll see in a minute, what the income thresholds are for Roths, or you can potentially do an after-tax or nothing. But you cannot do a pre-tax if you make more than 129, married, filed jointly, and you have access to a 401k at work. And what about if you're married, filed jointly, and your spouse is covered by a plan at work? So you're not, but your spouse is. Then if you make more than 214, it was 208 in 2021. And let me just give you the number for 21 for if you're married, filed jointly, and you are covered by a plan at work. For 2021, the number is 125K. 2022, it's 129K. Now, if you're married, filed jointly, and your spouse has access to a plan, but you do not, the number is 208 in 2021 and 214 in 2022. Okay, so why am I giving you the 2021 numbers? Because you can technically make IRA contributions all the way up until April 15th. So you're still in the game for 2021. That's why it's still important to understand the 2021 rules. Now, what about if you're single, head of household, I should say, and you're covered by a plan at work? it's 76,000 for 21 and 78,000 for 22. So if you're single and you work at Tesla and you have a 401k, if you make more than 78K at Tesla, or I should say in the aggregate in all your income, then you can't do a pre-tax IRA contribution. You can still contribute to Tesla, but because you have an access to a plan, the IRS wants to cap your deductions. And if you're married, filing separate, it's 10K in 21 and 22. So if you make more than 10K, can't do a pre-tax IRA contribution. Now let's go Roth, right? Roth. So let's say you want to do a Roth. In 2021, if you make more than 208, married, filed jointly, you cannot do a Roth. In 2022, that number is 214,000. So if you make more than 214 in 2022, you cannot do a Roth. Now, what happens if you're single, head of household, or married, file separate? It's 140 in 2021. It's 144 in 2022. Now, what is the workaround? You've probably heard me talk about backdoor Roth IRAs. That is still alive as of today. Obviously, the Build Back Better bill will potentially be resurrected. And if the provision in that bill remains in that bill, which eliminates the backdoor Roth IRA and the mega backdoor Roth 401k, then we'll have to see if it applies retroactively to 2022 or to the 23 taxable year. We'll see. But as of today, you can still do backdoor Roth IRAs. So if you make more than 214 in 2022, I should say, or 208 in 2021, then you can technically do an after-tax contribution and then just convert it to Roth and get those funds in Roth. Now, if you have other pre-tax IRAs out there from previous years, there's a pro rata formula which will basically limit how much you can convert of that after-tax amount to Roth. So just be cautious about that. I've done a bunch of blogs and videos, so if you want more info, you can just check those out, and it goes through the formula for how you calculate the pro rata amount that can be converted to Roth. So in sum, IRAs and Roths, which are the most popular categories of retirement accounts, 60 million plus, over $13 trillion in IRAs and Roth IRAs out there. They unfortunately kept the max contribution the same at $6,000 or $7,000 if you're over 50, which I talked about in a recent podcast. Is kind of disturbing, upsetting, because we know what things cost, right? Inflation. I went to get some dinner, picked up 2 chicken wraps at a regular restaurant, not a fancy restaurant in Miami. It was $42, chicken wraps. Okay. So we know inflation is here. I was speaking to someone yesterday who runs a bowling alley, and they were saying that they charge for 5 chicken wings, they charge $7.99. And he said before COVID, each chicken wing was costing him about 25 cents. Now, 98 cents. So he's basically breaking even on his chicken wings. And he can't raise fees or costs of the chicken wings because no one's going to buy it. So even the Fed understands this. They've pegged inflation at over 6%. So it's disturbing that they didn't raise the IRA and Roth max limits. It's too bad. I'm not sure what they were thinking, honestly, because they raised the SEP, they raised the SIMPLE, and they raised the 401k. And the most common retirement accounts in IRA and a Roth, and it's disturbing that the government, or at least the IRS, decided not to increase even by $500. So that's where we're at. Backdoor Roth is still in existence. So if you make over the 214, you can still do a Roth in 21. If you do it in 2022, we'll have to wait and see if the Build Back Better bill provision, if it remains, will be retroactive. I don't think it will be. I think they'll just change the year to 23. So I do believe we'll all be able to do backdoor Roths in 2022. But hopefully that provision gets removed and never comes back. But we'll see. Let's just go to the SEP IRA since we're in the IRA world. 2021, the SEP IRA max was $58,000. 22, it's $61,000. Remember, SEP is a profit sharing plan for a business. Individuals can't create SEPs, only businesses. So if you're a sole proprietor, Schedule C, W-2, and you have a business, you can set up a SEP. It's a 20% profit sharing on your adjusted gross income, Schedule C, or 25% W-2 or a guaranteed payment up to a max of $61,000. So you make $100K, and it's just you, to keep it simple, 20% of 100K is 20K. That's your max on the SEP. We'll see in a couple minutes how the solo K will allow you to contribute a lot more if you went with the solo over the SEP, which is what most smart small business owners do. Now, if you have employees, there's something called the 3 out of 5 year rule, where if your employees, once they work 3 out of the 5 years with you, you have to start offering them benefits, which generally is a profit sharing contribution akin to what you are taking as the owner. There's no catch up if you're over 50, whereas a solo K does have a catch up. Simple IRA even has a catch up. There's no Roth. All contributions are pre-tax. Simple IRA 2021, the max was $13,500. 22, it's $14,000. There's also a $3,000 catch up if you're over 50. Simples aren't that popular, so I'm not going to spend much time on them. Now let's go to the 401k world. Let's move into the employee deferrals. So remember, solo 401ks have essentially 2 components. They have the employee deferral and then the profit sharing. And then there's a third component where you can do what's called a mega backdoor Roth 401k, which, like the backdoor Roth IRA, is still alive. It's still basically in a state of coma. It's in a coma, I should say, or dormant. It's still alive. There's a provision in the Build Back Better bill, like the backdoor Roth IRA, which seeks to eliminate the mega backdoor Roth 401k. But since the bill is technically not law, you can still do mega backdoor Roth as of today, and I'll get to that in a minute and explain what really it is. But let's start with the maximum. So for 2021, the max you can do is to a solo K was 58 or 64.5 if you're over 50. In 2022, it's 61,000 if you're over 50, 67,500 if you're over 50. So it's a $3,000, or I should say $3,500 $3,000 increase, whether you're under 50 or over 50. So they gave you an increase in a solo. They gave us an increase in a SEP, 58 to 61. They gave us a little bump in the simple, but for some reason they did not give us the bump in the traditional Roth IRA, which again is kind of upsetting. So let's start with the employee deferrals. The max in 2021 was 19.5 or 26,000 if you're over 50. Those generally can be done in pre-tax or Roth. In 2022, it's 20,500, so the extra 1,000. And if you're over 50, it's 27 instead of 26. So you get the extra 1,000. Again, those can be in pre-tax or Roth, depending on your plan docs, and they are generally dollar for dollar. So if you make 20-something thousand bucks, W-2, you should be able to almost put in the full 20,500. Again, self-employment, if you're self-employed, Social Security and FICA will come out of that amount. So the net amount after that is available for contribution. There's a great calculator on our website. If you just Google like solo 401k contribution calculator, IRA Financial, you can plug in your net salary or your 1099 or Schedule C amount, and the calculator will actually give you to the penny exactly how much you can put in as an employee deferral and even a profit sharing for 21 or 22. So it's a really good tool to use if you're just kind of playing around. Obviously, your accountant will provide you that info when you file your return, but generally, you'll know. So again, 19.5 last year, 20,500 in 22, 26,000 if you're over 50 in 2021, 27,000 if you're over 50 in 2022. So now let's go to the employer contribution. Same rules, 20% if you're a single member LLC or Schedule C of your net Schedule C amount, 25% if you're a W-2 or a guaranteed payment. So let's play with some numbers here. 100K, under 50, single member LLC, and you want a max. 20,500 plus 20,000, giving you 40,500. Remember, SEP IRA would only give you 20% of 100 or 20,000. Okay, so here you're able to do 40,500, more than double. Let's say you're over 50 and you want a max. You can do 27,000 plus 20% of 100 or 47,000 versus just 20,000 for a SEP. How about if you're a W-2 and over 50? Okay, you can do 20,000 and 27,000 plus 25,000, 25% of 100, giving you 52. Okay, so the cap, remember, if you're over 50, is 67,500. So you're still under that cap. If you did a SEP and your W-2 made 100, you'll only get 25. Okay, so you see where I'm going. The solo K will trump the SEP IRA every time. The only time you should go SEP is really, if you're under 50 and you're going to max out. So you're under 50, you make 300K, right? You're going to, well, actually 300K times 20, 60,000. So you're almost at the max. So let's say you make 350. You're going to max out whether you do the solo or the SEP. Let's say you want the deduction. You don't care about Roth. You don't care about the loan feature. Then the SEP will work for you. But for everyone else, the solo K is going to win every time. Not only is it easier to reach your maximum contribution limit quicker, but you have Roth options on the employee deferral. You also have a loan feature where you can borrow $50,000 or 50% of your account value, whatever's less. You have the ability to do alternative assets. Well, the SEP you do as well. So also you have the ability, if you're a real estate investor, you have the ability to use non-recourse leverage without paying what's called a UBTI or unrelated business taxable income tax, which can travel as high as 37%. So the solo K is going to win every time on the SEP, unless you're under 15, you're able to max out anyways. Okay, so the solo K has some obviously major advantages over the SEP, and it has gone up considerably, $3,000 on the aggregate from 22 to 21. So let's talk about the mega backdoor Roth 401K. And as I mentioned, it's still alive and kicking. Who should do the mega backdoor Roth? Well, if you're a Roth lover, it's going to allow you to go dollar for dollar, 2021, 58 or 64.5 if you're a 50. In 2022, allow you to go 61 or 67.5 dollar for dollar. So the way the mega backdoor works is you're not making employee deferrals, you're not making employer contribution. You're kind of in the middle. So you literally just make a contribution into an account. You can keep a separate after-tax account. So some of my clients like to have 3 accounts: a pre-tax account, an after-tax account, and a Roth account. So if they want to do pre-tax deferrals or contributions employer-wise, put them into the pre-tax bucket. They want to do Roth, they can put them in the Roth bucket. And then the after-tax amount can go into that after-tax bucket. And then they can convert it, move it from after-tax to Roth in the plan, or they can even move it to a Roth IRA outside the plan without a triggering event. So again, here's an example. 100K. Let's say you're a single member LC under 50, 100K. You love Roth. If you did a SEP, well, you can do no Roth. You'd have to convert 20,000, 20% to Roth, pay tax on the converted amount. If you are solo 401K participant, you can do 20,500 in Roth, 19.5 last year, and then you can do 20% of 100, 20K, and then convert that to Roth. Okay, so the most you can do with the conversion is the 40,500. If you did the mega backdoor Roth solo K, you can do dollar for dollar 61,000 or 58 for last year, and then immediately convert to Roth. So on your $100,000 of income, you can do the full $61,000 contribution. Now again, it's still alive. It's alive for 2021. Is it alive for 2022? As of today, it is alive. Now, that could change, right? The longer the BBB bill does not get passed, the longer or the greater the chance is that the provision, whether it's included in the bill or not, but if it is included, there's a greater chance that it won't be retroactive. So if this provision gets stuck or remains in the Build Back Better bill and it gets passed in February or March, there's a good chance that they'll just change the date from 22 to 23, meaning you'll still be able to do the backdoor Roth for 2022. I don't know, right? No one knows what's going to happen. I am still praying to God that this provision will somehow get removed from the Build Back Better bill. I do think something's going to pass. President's made it clear that he's pushing. He's going to work with Senator Manchin. So I do think that a smaller version of the BBB bill will get passed. Senator Manchin has said on record that there are parts of it that he's okay with. Now, what's going in our favor, when I say our favor, I mean people that love the mega backdoor Roth, which I do, is inflation. Okay, as the numbers keep indicating that we're in a period of high inflation, that will put more pressure on Manchin and the other senators to somehow cap this bill. But again, the backdoor Roth IRA, the mega backdoor Roth 401k provision is not going to raise revenue at all. It actually will decrease tax revenue potentially because more people will just do pre-tax contributions. So it's not a money raiser. It's not inflationary. So this is a policy provision that Senator Wyden, I mentioned, and Congressman Neal seemingly care about. We know Senator Wyden of Oregon has an issue with Ross. We know his vendetta against Peter Thiel. And this is just another way of him trying to limit people's ability to put more money in a Roth. So I do think the longer this bill gets pushed, the better our chances are. But if it does get passed, I do think the provision will remain. Now, if it doesn't get passed in 2022, and let's say we're sitting here in the summer and the bill's still not passed, I don't think we'll see it because you're going to have midterms coming up, and it's just going to be more difficult to get something passed. So I think the Democrats and President Biden have the next 3-4 months to try to get some version of the BBB bill passed. I do think they'll do it. I'm praying it doesn't get done, even though there are some provisions in there that I support. The retirement provisions, I think, are quite negative. I think it's very poor policy to use people's retirement accounts to pay for some of these programs, even though I do agree with some of these child credit programs, the kindergarten programs allowing for childcare. There's some good programs in there, okay? So I would like to see that passed. I just, as someone who's very focused and a true believer in the retirement system as a way to bridge the wealth gap in our country, I'm discouraged by the fact that it's in there. And again, I'm praying that the provision somehow gets removed. So all in all, I don't want to spend too much time. It's kind of dry, I know, but let me do a quick recap. IRA and Roth IRA contributions remain like 2021, 6,000 and 7,000 if you're over 50. SEP is from 58 to 61,000. The simple IRA has gone up from 13,500 to 14,000. The solo K has gone up from 58 if you're under 50 to 61. If you're over 50, 64,500 to 67,500. Employee deferrals went up from 19,500 to 20,500, and if you're over 50, from 26 to 27. That's it. Okay, so that 30 seconds, I just summarized everything you need to know. Of course, we're here. If you're a client of IRA Financial, if you have questions, we're obviously here to help. But that's the most important thing. So let me get to some questions. Brian, does this apply to Roth as well? Yeah, the traditional IRA and Roth IRA limits are 6,000 or 7,000. So that is the same as 2021. Can I do a 2022 backdoor Roth IRA contribution now? You could. If you have enough income, if you believe or you feel like you are going to earn that income, yes. Now, if the bill passes, we'll see what happens, right? If the bill passes and it's retroactive to 12/31/2021, then you'll pull the contributions out, right? They're likely not going to be any excess contribution tax. The 2022 taxable year obviously hasn't going to run. You'll just pull it out, okay? And any earnings on that income you'll pay tax on. But I would do it now just to lock it in. Again, no one knows, right? Our insiders on the Hill, our industry insiders, we got amazing lobbyists that are working with us, educating members of Congress and the Senate on some of these retirement provisions. They've basically told us that, hey, the longer this goes without passing, the better it is, obviously, and the better chance it doesn't become retroactive. And even if the provision remains in the bill, it likely will just be a 2023 target year. So we'll see, Jamie. But yeah, I know, referring to the backdoor, I got you. Dave, employer contributions on solo K, 25% of W-2. If the employer contribution is made in February 2022, after W-2s are available, can the business take this as an expense for 21 taxable year? So it's a great question. You can talk to your accountant about this. Generally, that's the way it's done. You have the ability to make the employer contribution in 2022 for the 21 taxable year. So generally, yes, that is the way it's done. That's the way one of the companies I own, that's the way we do it. We'll do the 3 other companies I own, we do the employer contributions. Well, let me rephrase that. We do the safe harbor contributions. One company that does profit sharing, technically, yeah, we do it in 2022 22 for 2021, and we'll take the deduction for 2021. But I've heard some accountants that are cash basis taxpayer accountants will take it in the year the contribution's made, so 2022 for 2022, even though the contribution is based off 21. I think the more common approach is you take the contribution deduction for the 21 because it's based off the 21 number. So it's a great question, Dave. If I convert Roth 401k to a Roth IRA, can I access the money penalty free after 5 years if I'm under 59.5? So Ryan, good question. So let's say you do a backdoor Roth 401k and you go to a Roth IRA without the triggering event. Generally, you need to wait to your 59.5 to pull the contribution amount, the converted amount tax-free. Once you're over 59.5, you can pull the converted amount tax-free. The earnings are still subject to the 5-year limit. But if you're under 59.5, Ryan, you got to wait to your 59.5 to pull the converted amount out. It sucks because if you do make the contribution directly to Roth, you don't have to wait to 59.5 to pull the money out. But once you do a conversion, that 59.5 year rule is required in order to pull the converted amount out. The earnings are still subject to 59.5 in a 5-year rule to be a qualified Roth IRA distribution. What do you mean by collectibles when you say that the Roth LLC can't buy collectibles? So collectibles, I mean art, baseball cards, stamps. The IRS gives some examples in Section 408M what a collectible is. There's an exemption for precious metals like pure bullion, gold, silver, palladium, American Eagles, and bullion coins. Those are not deemed collectibles, but basically it's like baseball cards, hobby stuff, antique cars, rugs, stamps, NFTs, maybe, right? Some NFTs, non-fungible tokens, which you may have invested in, or maybe your kids are telling you about. I know my kids are super into NFTs. Probably some of the art stuff is a collectible. I'm not sure about all NFTs. We'll see, because there are some various functions for NFTs other than just having a picture on your phone. So we shall see. Okay, there's some gibberish here. Mike, I have only one bank account for my solo 401k Roth, not after tax. Can I just move the 56K straight into it for backdoor Roth, or do I have to open a second? Good question, Mike. You do not have to open a second. You can use one account. Okay. I like to, because it's just clean, just to have 3 accounts or 2 accounts and just kind of show the flow of money, but you're not required to at all. So don't worry about that. You're certainly not required to do that. Okay. So I don't want you to think you have to do that. It's just from an accounting standpoint, sometimes it's a little easier if you have sub accounts, separate accounts, but otherwise it's up to you. Were there any changes in legislation to self-directed IRAs for private placements? Keith, no. Thankfully, there was 2 provisions in the House version of the tax bill, which was dropped September 15, 2021, which sought to eliminate accredited investor investments for IRAs or eliminate investments for IRA owners on 10% or more. Those provisions have been kicked out. So thank you. And we worked hard, and so do all our clients. Our entire industry, Keith, banded together, and we spent a lot of time. I mean, I can't tell you how many members of Congress and senators that I spoke to, and my fellow colleagues did as well. It was really nice to see our industry come together. Whether we compete or not, we're friendly competitors. Why? Because there's so much business out there. You guys all know the power of self-directed retirement accounts. 60 million IRAs, and we only control 3 to 5% of the IRA investments. 95% or so is still invested in traditional investments. So there's no need to compete because there's so much potential business out there. So yeah, obviously we want to get all the clients we can. We are competitive. I'm sure each think that we have the best product, but we're friendly, and we know we have to work together because we want to obviously enhance our industry. And as our industry gets more popular, investors gain more knowledge and education about our industry, it's going to help us all out. So those provisions are gone, out the door. And hopefully we'll never, ever, ever see them again. So thanks, Keith, for that question. Dave, another question. On the 25% of W-2 employer contributions, this time for the upcoming year, can I do the 25% for tax year 22 and Q1 if I want to exceed 25% of W-2 at the end of the year? I mean, technically you can. It's hard. You could, right? I mean, if you're not going to exceed the 25%, yeah. If you have an idea what your W-2 is going to be, then technically, yes, you can do it. It's not common, but you can do it, right? So if you make 100K and you know that's your W-2, technically, if your business can do the 25K today, right? Assuming you've earned it. Now, there's some question is whether you earned that 100K already. So there's some gray in that because technically you have to earn the income in order to get the contribution. But I've had clients do it. Okay, I'm not sure that would be something the IRS would audit. They generally would look at the contribution from a year-end standpoint, not on a timing standpoint. So I wouldn't be so worried about an IRS audit, Dave, on that. But technically, you've had to earn the income in order for the company to have made the contribution. Mr. SK, do we need to file any tax form to IRS for converting regular 401k to Roth IRA? Yeah, you're going to need to do a 1099-R. If you're a client of IRA Financial, we can do it for you. And you're a member of our compliance service, which you definitely should for $199 a year. It's a no-brainer. We can do that for you. Just get a hold of us, and we'll file the 1099-R for you. It's due end of this month, so let us know. We'll actually be sending a newsletter out about that. Self-directed IRA. Okay, well, if you do a conversion in your IRA, then yeah, and IRA Financial Trust is your custodian. Yeah, we'll file the 1099-R. Don't worry. That's part of our custodial fee. So 100%, we will take care of that for you. There you go. Looks like it's light on questions today. I guess everyone's still on vacation from New Year's. Good. Okay. So hold on. I got one more from Julie. What is the bottom line on choosing a solo K versus taking the qualified business income deduction? Thanks. Love your chats. Okay. So the solo K should run parallel to any qualified business income deduction. So your solo K, if you're self-employed, is going to run off your net Schedule C. Okay. So obviously, if you make contributions, that is a deduction, right? So it's a qualified business income deduction. It's going to reduce your taxable income. So it's a very powerful deduction because it's not only deducting your income, but it's also allowing you to use that income and invest it in a tax-deferred way, compounding returns without paying tax. So it's probably the most rewarding deduction you can do. If you take a home office deduction or a charitable deduction, it's just giving you a deduction, but that money is still not in your pocket. You sent that money to the Red Cross, or you've used that money to buy equipment or the like. Here, you're deducting the contribution, but you also get to play with that money, and it's ultimately going to be yours down the road. So, yeah, it's a great source of deductions. Even if you don't itemize, you can still do the solo K deduction. So it's a great way to do it. Thanks for all your hard work on the legislation and for doing these chats. Always a good time. Yeah, I love these chats. I want more people to participate. So the more participation, the better. I love just communicating and chatting with all of you. So if you got questions, don't be shy. There's no dumb question. Said this repeatedly. My first day of law school, first year law student, back in 1997. I'll never forget the first day in class. I think it was torts, criminal law or torts. And the professor said, don't be shy. There are no dumb questions. If you have a question, there's probably 10 colleagues that have the same question. They're just shy to state it. So fire away. Don't worry. They're all good questions. Next one. Regarding the 144 income limit for a Roth contribution in 2022, is that limit for earned income or all yearly income? Yeah, it's earned income. It's a good question. So actually, it's depending on where you are, it's all income. So it includes capital gains and other income as well. So it's a good question. So if you look at the rules, even though you may have capital gains, so if you only have capital gains income, you're only going to, you're not going to be able to make any contributions. So it's all based off your modified AGI, okay? And that's the number you have to remember. So your MAGI, so the IRA uses a term called modified adjusted gross income. And it takes your adjusted gross income and it adds back certain deductions like half your self-employment tax, your IRA contributions to Social Security, losses from publicly traded partnerships, tuition expenses, rental losses, things like that. And you calculate your modified adjusted gross income. You have to find your AGI from your tax return, and it's on line 8B, okay, of the 1040. And then from there, you'll be able to determine how much you can contribute. So it's all based off your AGI, okay? So obviously, you want to make sure that you're checking what your AGI is. And if you look at the IRS definition of your AGI, I'll just read it for you. I actually have it up here. It's defined as gross income minus adjustments to income. Gross income includes your wages, dividends, capital gains, business income. So to answer your question, it's going to include everything you mentioned, okay? Capital gains, rental income, any income. So something to keep in mind. So even if you have only $10,000 of earned income, but you got $300,000 of capital gains, it's going to include all that, but you're going to have to take some of that out in order to get to the real adjusted gross income for your contribution limit. So it's somewhat confusing, but you have to take into account capital gains to get your answer. What are the steps we need to take in the new year after making backdoor Roth contributions to Solo K Roth 401k last year? Is there some tax form I need to get? So no, the only thing, Mike, you got to file is a 1099-R. There's no tax on the conversion when you go after tax to Roth, but you have to file the 1099-R, and that's the record you'll have showing that you have a Roth, right? Obviously, when you file a 5500 EZ, if you have more than 250K, you'll be able to show contributions, but your 1099-R will show the after-tax conversion of Roth. You'll code it as such, or we'll code it as such, and that will be your proof what you did. Thanks for having the most comprehensive IRA channel and business out there. I try my best. Obviously, if I can use my law background, all the money my dad spent on law school, and an extra year of master's of tax law, and my 9 years as a tax associate at some of the largest law firms in the world, if I can share that with you, I love doing that. It's my pleasure. That's what it's all about. So thank you, everyone. Happy New Year. Where do we file 8606 form? When do we file the 8606 form? 8606 form, I'm not sure when you're going to need that. Let me check. For non-deductible IRAs, you're going to file that with your return. Okay. So that's, again, if you do non-deductible IRA contributions, you're going to file that with your return. Okay. So that's if you're doing the after-tax to Roth, or you're doing any type of conversions from traditional SEP to Roth, you can file that as well. But that's not going to be for the backdoor Roth 401k. That could be for the backdoor Roth IRA, but not for the backdoor Roth 401k. Happy New Year to everyone. Thanks again. I do this every week, Wednesday, 12 Eastern Standard Time. So I know it's not always convenient for all of you, but you can send in your questions to info@IRA Financial and just say Ask Adam, and they'll get to me. And this way, I'm happy to answer any questions, and I will do my best to get them on the chat so other people that are listening or watching at a later time could learn. I mean, it's the best way to learn is not from me, but from me answering questions, and we can all learn together. So please participate. I love talking to all of you guys and ladies, and the chat part's the best part. So again, thanks everyone. Happy New Year. All the best. Stay healthy, and talk to everyone again next week.